There was a time when walking into a Red Lobster felt like walking into the official dining room of middle-class celebration in America. Birthdays, graduations, a little promotion at work that finally meant a bit more money on the paycheck, it all ended up under those red neon claws. Not only was this chain the undisputed king of casual seafood, at its peak it controlled more than 700 restaurants and a loyal family audience that treated it as the default place for special. Now let me take you back to 2023. The dining room is packed. Servers are sprinting between cramped tables, trays loaded with Cheddar Bay biscuits, and plates of shrimp that never seem to stop coming. The air smells like garlic, fryer oil, and just a hint of desperation. At the center of it all, glowing above the chaos, is a promise in bright letters: endless shrimp. $20, all you can eat. On paper, it looks like a triumph. Every booth full, a wait list at the door, social media flooded with photos of towering shrimp plates and proud, slightly dazed customers on their fifth refill. Managers are counting heads, not margins. The company finally has a hit again. Yet behind the kitchen doors, something else is happening, something that turns this crowded dining room into a slow leak in a billion-dollar hull. Because that $20 deal did not just move shrimp, it moved the entire economics of the chain. Food costs spiked, labor hours stretched, and the kind of guest who shows up for endless anything is not the guest who quietly orders a single entree and a full-price drink. The more popular the promotion became, the more money it quietly burned. This is the paradox at the heart of the story: a wildly successful, all-you-can-eat offer that helped erase hundreds of millions in value and push a national icon into Chapter 11 bankruptcy. Red Lobster's life did not begin in chaos. It started as a modest Florida restaurant, then grew into an empire under corporate parents like General Mills and later Darden. For decades, it turned frozen seas into steady wealth, translating mass-market seafood into a ritual for millions of families who had never seen an ocean. His story is one of scale, discipline, and a very specific promise: affordable luxury without needing a passport or a yacht. But it is also a story of misaligned incentives, private equity owners looking for quick efficiency, a global shrimp supplier with every reason to sell more shrimp, a tired brand desperate for relevance. Endless shrimp was not just a pricing mistake, it was an example of what happens when financial engineering, supply contracts, and human appetite collide. At times inspiring and at times chilling, this collapse stretches from humble Florida beginnings to corporate glory and finally to a slow-motion financial train wreck, where one glowing $20 sign became the symbol of a much deeper rot. How did that happen? This collapse is not just about shrimp. It is about how a modern restaurant empire can look busy, smell like garlic butter, and still be quietly bleeding out behind the kitchen doors. Red Lobster's fall is a case study in the new math of casual dining, where debt loads, corporate landlords, and distant owners can hollow out a beloved brand long before the dining room empties. Food costs rise, labor gets tighter, leases get heavier, and seafood sits at the worst intersection of all three. One bad quarter in shrimp prices, one aggressive rent increase, one too good to be true promotion, and the numbers stop working long before the neon sign flickers. There was a time when this chain was the dream. A single Florida restaurant in 1968, a family-style seafood place in a landlocked world, grows into a national icon. General Mills steps in, then Darden, and suddenly it is the place where middle-class America goes to taste wealth on a Wednesday night. His story is one of expansion, efficiency, and corporate power, at times inspiring and at times chilling, as the brand becomes less about one dining room and more about quarterly earnings. Then the ownership changes, private equity arrives. Thai Union, one of the world's largest seafood suppliers, takes a major stake. Cost-cutting, menu simplification, sale-leasebacks, and financial engineering begin to matter as much as cheddar biscuits. On paper, that looks rational. In practice, it's an example of what happens when the people who control the money also control the shrimp. So here's the central question. How do you go from industry dominance to closing around 100 stores and listing over $1 billion in liabilities, all while running a promotion customers cannot stop ordering? How does a $20 endless shrimp deal designed to drive traffic help erase hundreds of millions of dollars in value from a 700-restaurant giant? The answer lives in margins measured by the ounce, in contracts written a continent away, and in a boardroom that thought humans would tap out after 3 plates. To understand that, let me take you back to the beginning. From the 1960s Florida origins through the disciplined General Mills years, into the Darden era of national scale, then into the private equity and Thai Union period, where debt, leases, and supplier incentives start steering the ship. Finally, the story arrives at one decision, making endless shrimp a permanent $20 fixture in 2023, and watching it distort customer behavior, unit economics, and eventually the bankruptcy filings. Along the way, this video will give you tools: how to look at all-you-can-eat and limited-time deals and see the hidden bet behind the marketing, how executive bonuses, supplier agreements, and short-term stock pressures shape decisions that frontline workers and loyal families pay for, and how the same pattern shows up today in gyms selling ultra-cheap memberships, streaming platforms chasing growth at any cost, and retailers hooked on constant discounts. Because Red Lobster is not an isolated shipwreck. It is a warning buoy for the modern economy, flashing a quiet message about what happens when the pursuit of traffic, leverage, and short-term profit finally hits the rocks. There was a time when the phrase seafood dinner didn't mean a bright red logo off the highway. It meant a long drive to the coast, a white tablecloth, and a bill that made a middle-class family swallow twice before ordering dessert. Let me take you back to the 1950s and 60s. America was building a new dining empire. Steakhouses throwing giant slabs of beef on the grill, shiny diners open all night, and a fast food revolution teaching the country that burgers and fries could be cheap, predictable, and everywhere at once. Meat was comfort, meat was power. And seafood? Seafood was a niche luxury, locked to the coast and to people who knew which fork to use. For the average inland family, fish was either a frozen brick from the supermarket or a mysterious dish from a menu written in another language. Lobster sounded extravagant. Oysters sounded dangerous. Even shrimp carried a quiet risk. What if it wasn't fresh? What if it smelled wrong? What if tonight's special left everyone regretting their life choices tomorrow? Behind that anxiety was a real logistical problem. Unlike beef or chicken, which could be slaughtered, chilled, and shipped on reliable schedules, seafood was fragile and moody. It spoiled quickly. It needed careful handling, cold storage, and precise timing. In the 50s and early 60s, the national supply chain for fish was a patchwork of regional distributors, ice-filled trucks, and local wholesalers, all trying to move a product that started dying the moment it left the water. That made consistency almost impossible. One restaurant's shrimp cocktail might be pristine. Another's might taste like it had sailed around Cape Horn twice. Prices swung with the seasons, the weather, and the catch. If a storm hit the Gulf or a boat came back light, the menu cost jumped. Because of those fragile economics, most chains avoided seafood or treated it like a token menu item, not the star of the show, which left a gaping opportunity. Millions of inland Americans were getting a taste for dining out, for birthdays and anniversaries and, We finally got the promotion nights. They wanted something that felt special, a break from the usual steak or burger, but they also wanted safety, a place where the shrimp would taste the same in Kansas as it did in Florida, where the bill wouldn't explode, and where no one at the table had to pretend they knew how to crack a lobster claw. Into that gap would step a new idea, a chain that promised to tame the ocean, to demystify seafood with laminated menus, smiling servers, and predictable portions. Not a glittering coastal palace, but a slightly upscale yet approachable dining room, where a family could trade up from burgers to lobster tails and feel for one night like they were sharing in a different kind of wealth. His story is one of turning chaos into control. Red Lobster's story would be the same, at times inspiring and at times chilling. It's an example of what happens when a company learns to standardize something unpredictable and make money doing it. The real question is how that same empire, built on controlling risk, finally wagered everything on the most unpredictable offer of all: endless shrimp. There was a time when seafood, for most American families, meant a frozen fish stick from the supermarket oven. In the late 1960s, eating shrimp in a restaurant felt like a vacation luxury, not a Tuesday night option. Let me take you back to 1968, to Lakeland, Florida, where one man decided to rewrite that rule. His name was Bill Darden. Not a celebrity chef, not a Wall Street operator, just a restaurant lifer who'd grown up watching ordinary people count every dollar when they ate out. His story is one of quiet calculation rather than flashy genius. The first Red Lobster he opened wasn't some grand palace on the water. It was a modest, boxy building in a central Florida strip. Simple decor, nautical knickknacks, red seats, wood paneling, and a sign that promised something bold: seafood that felt coastal, at prices that felt safe. The core idea was disarmingly clear. Take what rich tourists ate on the coast and make it feel accessible to a family from inland Florida. One laminated menu, no confusion. Fried shrimp, fish fillets, clam strips, a lobster tail that sounded daring, but arrived with drawn butter and instructions from the server. The flavors were adventurous enough to feel like an escape, yet familiar enough that a nervous dad doing the mental math on the bill could relax. Predictable prices, predictable portions, predictable comfort. Behind that simplicity, the operation was anything but simple. Seafood is volatile. Prices jump with the weather, with fuel costs, with distant storms no one in Lakeland would ever see. Darden had to build relationships with suppliers who could deliver consistent quality shrimp and fish to a landlocked town week after week without blowing up the food costs. In the kitchen, many cooks had never handled raw seafood at scale, so he drilled them on handling, storage, fry times, and what to throw away even when it hurt the margins. Then there were the locals. In a town used to diners and burger joints, a place called Red Lobster sounded almost too fancy, maybe too risky for the family budget. So the team trained servers to translate the menu into plain language, to steer nervous guests toward safe bets, and to make lobster tails feel less like a gamble and more like a treat that had already been financially pre-approved. Every detail became an experiment. Darden tested portion sizes, shaving an ounce here, adding an extra shrimp there, watching how guests reacted when plates looked full but not wasteful. He nudged prices up and down in small increments, always tracking whether the dining room stayed busy. Even the menu layout was strategic: high-margin fried shrimp centered and highlighted, pricier items present but not screaming for attention. It was an early lesson in balancing perceived generosity with actual food costs. Long before anyone imagined an offer like endless shrimp would stretch that balance past the breaking point. And then it worked. Lines formed in the parking lot. Families waited for an hour to eat seafood in a town nowhere near the ocean. The Lakeland experiment proved that standardized, affordable seafood could be scaled. A much bigger player noticed. Soon, a corporate giant would arrive with money, power, and plans to turn this small Florida outpost into a national empire. And that is where the story accelerates. There was a time when Red Lobster was just a clever Florida experiment, with lines in the parking lot and a few hopeful bankers on the phone. Then a very different kind of diner walked in, not a family of 4 from Lakeland, but a corporate giant from Minneapolis that smelled money, power, and scale. Let me take you back to the 1970s, when America was falling in love with casual dining, steakhouses, salad bars, fern bars, anything that felt nicer than fast food, but cheaper than white tablecloths. General Mills watched this from afar. Not only was it the cereal king, it was a growing conglomerate, quietly assembling an empire of restaurants to capture this new middle-class ritual of going out to eat on a Tuesday. Because General Mills had already moved into brands like Burger King, and later Olive Garden, executives could see something others missed. Seafood was fragmented, risky, and intimidating for most home cooks. Yet the Lakeland units were proving that standardized fried shrimp and cheddar biscuits could be printed almost like cereal boxes. The logic of the acquisition was cold and simple. Strong unit economics, repeatable operations, and a chance to own the national seafood category before anyone else understood it was even a category. Once the deal closed, the tone changed. The scrappy regional chain was plugged into a machine. Centralized purchasing meant Red Lobster could lock in contracts for shrimp, fish, and potatoes at volumes local owners could only dream about, shaving pennies off every plate that turned into millions across dozens, then hundreds of stores. Standardized training manuals appeared, filmed modules, checklists, and secret shopper reports that measured whether every dining room in Ohio felt like that first one in Florida. Site selection turned ruthless and scientific. Demographic heat maps, traffic counts, proximity to malls and highways. Teams fanned out to plant those red roofs in the exact middle of America's new suburban life. Because of this disciplined rollout, average unit volumes were strong. Food and labor costs stayed in line, and the value proposition was crystal clear. Seafood as a special but affordable night out. You might not fly to the coast, but you could drive to the edge of the strip mall and feel like you had. In those early years, his story is one of control and discipline, at times inspiring and at times chilling in its efficiency. It's an example of what happens when corporate capital, logistics, and branding all point in the same direction, which quietly raises a question that will haunt the rest of this story. How does a chain engineered around tight margins and careful portions end up running a promotion where every extra plate of shrimp walks the company closer to bankruptcy? Hold that thought, because the answer begins with what happens when the empire changes hands. When that empire changed hands, it didn't just sit still. It went looking for new territory. And for Red Lobster, territory meant one thing: the American suburb. There was a time when every booming edge-of-town development came with the same package deal: a new mall, a 6-screen theater, a highway exit, and sitting proudly by the parking lot sea of minivans, a Red Lobster. The strategy was deliberate. Go where young families were buying their first homes, where paychecks were rising, but true luxury still felt out of reach, and offer a night out that looked fancy in the commercials, yet it felt safe enough for a toddler meltdown at table 7. Let me take you back to those Saturday nights. Parents in church clothes, kids arguing over crayons, a beeper buzzing in a crowded lobby. For millions, this was the first contact with seafood as a category, not just fish sticks from the freezer. Red Lobster turned lobster tails, shrimp scampi, and crab legs into middle-class milestones. Birthdays, graduations, anniversaries, even awkward first dates, all folded into the same ritual of laminated menus, shared platters, and a bill that hurt just enough to feel special. The power came from how formulaic it was. Step inside almost any location and the design snapped into place. Dark wood, nautical ropes, ship wheels, framed photos of lighthouses that had never seen a Red Lobster ad. Near the entrance, a tank with live lobsters, quietly doing the marketing work, telling every kid in the room that this was real seafood, not just fried mystery meat. Servers dropped baskets of Cheddar Bay biscuits that were technically free but functioned like currency, buying patience, loyalty, and repeat visits. On the plate, the chain walked a careful line. There was the fried comfort food that felt familiar and safe, piled high with fries and cocktail sauce. Sitting right next to it were aspirational dishes, lobster dinners, mixed grills, shrimp trios that promised a tiny taste of coastal wealth to families living hundreds of miles from any ocean. His story is one of how a brand can sell not just food, but a brief escape from ordinary life. Because the model was so repeatable, the numbers climbed fast. From a handful of units in Florida, Red Lobster expanded across the Sun Belt, then the Midwest, then the coasts, eventually crossing borders until the chain could claim more than 700 locations worldwide. Not only was it the default seafood option in town, it became shorthand. Let's go to Red Lobster meant casual seafood in the same way Kleenex means tissue. At times inspiring and at times chilling, it's an example of what happens when standardization turns a restaurant into infrastructure. The very sameness that made the chain comforting also made it fragile. Because once every dining room, every tank, every biscuit oven ran on the same playbook, a single mispriced idea wouldn't just hit one store. It would echo through all 700. And that is where Endless Shrimp stops being a fun promotion and starts becoming a system-wide weapon pointed inward. To see how dangerous one mispriced idea can be, you have to step inside the machine. Not the billboard, not the commercials with slow-motion butter, pores. The money machine. The single Red Lobster dining room that, multiplied by 700, became an empire of seafood and rent checks. There was a time when a typical unit was almost boring in its predictability. A few $1 million a year in revenue, week after week, driven by a simple equation: how many people sit down, and how much money each one leaves behind. Say the average check is around $25. On a busy weekend night, 300 guests cycle through the doors. That is $7,500 in sales before the lights go off, before the last family drifts out smelling like fryer oil and garlic. From that top line, the knife comes out: food, labor, rent, overhead. In casual dining, food cost alone usually eats 28 to 32% of sales. Pay a bit too much for ingredients, give away a bit too much on the plate, and that number creeps up. Labor sits in a similar band: servers, cooks, dishwashers, managers, all the people whose life is timed to the Friday dinner rush. Together, food and labor can easily swallow 60% of every dollar before a single bill is paid to landlords or lenders. Here is where the math turns ruthless. If food cost rises from 30 to 33% and labor nudges up from 30 to 32, that 6-point swing can erase the profit of an entire store. A unit that once threw off a tidy margin for corporate suddenly breaks even, or worse, becomes a quiet little hole where wealth goes to die. A few percentage points are not an accounting detail. They are the line between expansion and closure. Seafood makes that line even thinner. Shrimp, lobster, crab, all arrive with higher base costs and shorter lives. They spoil faster, they demand cold storage, They depend on global markets where storms, disease, and fuel prices can yank costs up without warning. It is an example of what happens when a menu is chained to the ocean. If prices are not watched daily, if portions are not controlled, a good week of traffic can still end in poverty on the P&L. So a hypothetical Red Lobster has that $25 check, those 300 covers, but not everyone orders the expensive items. Some choose pasta, some choose chicken, some share appetizers. That menu mix is the quiet hero. It keeps average food cost in that precious low 30% range, lets the restaurant finally pay rent, lights, corporate overhead, and still send a little profit up the chain. Now imagine, in the middle of that delicate balance, one dish appears. High cost, all you can eat, and instantly beloved. Guests stay longer, eat more, order fewer high-margin sides. The P&L does not bend, it snaps, and when the same offer rolls out to hundreds of identical dining rooms, the damage does not stay local. It goes system-wide. And Endless Shrimp was designed to do exactly that. Endless Shrimp was the grenade, but the room it exploded in had been carefully built decades earlier. There was a time when Red Lobster wasn't a punchline or a bankruptcy headline. It was a pillar inside one of the most powerful casual dining empires in America. Let me take you back to the 1990s, when Darden Restaurants spun out of General Mills and suddenly owned two of the most recognizable names on the highway, Red Lobster and Olive Garden. Not only did that give Darden enormous scale, it gave them balance. Olive Garden handled the Italian comfort side of American life. Endless breadsticks, giant bowls of pasta, families celebrating graduations and Tuesday nights with the same Alfredo. Red Lobster became the slightly more premium sibling, the seafood night out, where the money felt a little bigger, the occasion a little rarer, the power of the check average a little higher. Together, they covered birthdays, paydays, and everything in between. One brand leaned into value and familiarity. The other leaned into indulgence and the fantasy of coastal wealth, even if the nearest ocean was a mall parking lot. It was an example of what happens when a corporate parent can segment the same middle-class guest into different moods, different cravings, different price points. During the 1990s and early 2000s, that strategy worked. Traffic was strong, dining rooms were full, and both chains had real cultural relevance. Ads like "When you're here, your family," and those slow-motion shots of lobster tails cracking open weren't just marketing. They were part of how American families imagine going out to eat. Promotions hit hard, but crucially did not yet blow up margins. Limited time events, seasonal seafood feasts, and yes, early versions of Endless Shrimp drove repeat visits without turning every table into a loss. But even in that golden age, the warning lights were flickering. Seafood pricing is notoriously volatile. One bad harvest, one storm season, one currency swing, and the cost of a plate could jump overnight. At the same time, tastes were shifting toward fresher, lighter, faster options. Fast casual chains chipped away at lunch. Steakhouses and higher-end concepts nibbled at dinner. Darden's executives spent years quietly tweaking portion sizes, rewriting menus, and nudging price points upward to protect profitability without breaking the illusion of abundance. Inside those boardrooms, the debates grew sharper. Which brands were essential to Darden's future, and which were legacy trophies from a different era? Olive Garden, with its massive scale and cheaper pantry, looked easier to defend. Red Lobster, chained to volatile seafood and aging real estate, looked harder to modernize without alienating its loyal guests. His story is one of corporate portfolio theory rather than a single villain, but the effect was, at times, inspiring and at times chilling. While guests cracked into lobster claws, Darden was quietly deciding which child to keep. Eventually, Red Lobster's fate shifted, not with a bang, but with a board vote that moved it one step closer to the exit door. There was a time when endless shrimp wasn't a threat to a 700-restaurant empire at all. It was a seasonal ritual, a controlled burn the company lit on purpose, then carefully put out before it scorched the balance sheet. Let me take you back to those early years. Endless shrimp would appear like clockwork near the end of summer or in the post-holiday slump, right when dining rooms went quiet and managers started staring a little too long at empty booths. For a few weeks, banners went up, commercials ran on loop, and families who watched their money the rest of the year suddenly circled a date on the calendar. Shrimp season was back. The psychology was simple and ruthless. The word endless hits a part of the brain that loves beating the house. Guests walked in dreaming of plate after plate, vowing to get their money's worth. But human stomachs are not marketing slogans. Most people tapped out after a couple of refills, long before the restaurant's food costs spiraled out of control. On paper, the deal looked dangerous. In practice, the average guest behaved predictably. Red Lobster made sure of that. The endless part applied to very specific preparations: grilled skewers, breaded bites, shrimp tossed in a creamy sauce that filled you up fast. First plates were generous, refills a little tighter, each one taking just long enough to arrive that guests had time to fill up on Cheddar Bay biscuits and sweet drinks. It wasn't an accident, it was an operating model. Servers were trained to protect the margins. While guests chased shrimp, the real money came from margaritas, upgraded sides, and desserts that quietly turned a bargain into a healthy check average. A table might come in for the $20 headline, but leave having spent closer to $30 or $35 per person. That gap was the difference between a fun promotion and financial self-harm. For a while, it worked almost too well. Lines snaked out the door on weeknights that were usually dead. Social feeds filled with photos of towering shrimp plates and proud declarations of fourth refill. Regulars treated endless shrimp like a holiday. There was a family rhythm to it, the same way some people plan their lives around tax refunds or Black Friday. The promotion became a tradition, not a permanent expectation, and that seasonal boundary mattered. Because it ended, kitchens could recover, food costs could normalize, and the brand could reset prices before the next cycle. It's an example of what happens when a risky idea is kept on a short leash. High traffic, controlled damage, a marketing win that didn't rewrite the whole menu. So here's the question that turns a clever stunt into a slow-motion disaster. If limited endless shrimp was already driving traffic and loyalty, what changed inside the business that convinced someone to make it permanent and cheaper? What changed was not just a coupon. What changed was the entire world around Red Lobster, slowly tilting away from everything the brand had been built to sell. There was a time when a big, heavy, sit-down meal was the reward at the end of a long week. Families blocked off Friday night, waited for a booth, and treated bottomless biscuits and fried platters as a kind of affordable luxury. But let me take you back to the late 2000s and 2010s, because the American dinner table was being quietly rebuilt by very different forces. Fast casual chains promising real food, real fast, delivery apps that put almost any cuisine a thumb tap away, and a new obsession with health, macros, and eating light. Red Lobster was designed for a different era. Long dining times, big portions, heavy sauces, and a check that made sense when eating out felt rare and special. Suddenly, the competition was bowls, wraps, and customizable salads that could be ordered, photographed, and consumed in less time than it took a server to recite the seafood specials. Younger diners were building a new food culture around customization and Instagram. while Red Lobster's core menu still read like a 1990s vacation brochure. The guest mix reflected that shift. The loyal base aged, kept coming for birthdays and anniversaries, but came less often. Meanwhile, the 20-something who used to graduate into casual dining was now splitting money between Chipotle, Korean barbecue, sushi burritos, and whatever looked best under neon lighting on social feeds. Shrimp scampi under a heat lamp did not have the same pull as a rainbow poke bowl. Then the money shock hit. The 2008 financial crisis slammed household budgets, and the recovery that followed never fully restored the old middle-class rhythm of big family dinners out. People still went to restaurants, but they hunted value, clipped digital coupons, split entrees, and watched every discretionary dollar. At the same time, new chains armed with lower labor models and cheaper real estate nibbled away at the edges of Red Lobster's empire, unit by unit, table by table. Inside the company, the numbers told the same story, at times inspiring and at times chilling. Years of flat or declining same-store sales. Margins squeezed by rising seafood costs and wage pressure. More locations quietly slipping from anchor of the plaza to underperforming box with a giant rent check attached. On internal scorecards, Red Lobster no longer looked like a crown jewel. Next to faster-growing brands in Darden's portfolio, it looked tired, expensive, and hard to fix. It's an example of what happens when a concept built for a different economic climate, different tastes, and a different pace of life keeps waiting for the old world to come back. Traffic slipped, relevance faded, and the once confident seafood giant started to look less like a growth engine and more like a liability. Finally, in 2014, the parent company stopped waiting. Darden made a decision about Red Lobster's future that would rip the chain out of its corporate shelter, hand it to new owners with very different priorities, and set in motion the events that turned endless shrimp from a clever promotion into something far more dangerous. Darden's decision came down like a gavel. In 2014, after years of sluggish sales and investor anger, the company announced it would sell Red Lobster to Golden Gate Capital, a private equity firm, for about $2.1 billion. Not only was the price tag big, much of that value wasn't for shrimp, servers, or brand loyalty. It was for land. There was a time when Red Lobster quietly owned a huge chunk of its real estate. Suburban parcels, waterfront pads, freestanding boxes with their own parking oceans. On a balance sheet, that looks sleepy. To Wall Street, and especially to private equity, it looks like buried treasure. So the deal was structured to unlock that treasure by selling off the properties and turning the restaurant empire into a renter in its own dining rooms. Let me take you back to the mechanics, because this is where the story of endless shrimp really starts to twist. Golden Gate effectively helped separate the dirt from the business. Red Lobster's locations were sold to a real estate buyer, then leased back on long-term contracts. Overnight, what had once been a relatively low occupancy cost became a fixed, rising rent bill that had to be paid every month, no matter how many Cheddar Bay biscuits walked out the door. That is classic private equity. Use leverage, extract cash up front, load the operating company with obligations, then push management to squeeze more money out of the same assets. His story is one of discipline and scale. Theirs is one of spreadsheets and clocks. The goal is not to own a brand forever. The goal is to boost EBITDA, pay down debt, and flip the company for a profit within a few years. Because of that model, the life of Red Lobster changed. It now had higher rent, new debt from the acquisition, and owners whose success depended on aggressive cost-cutting, tighter labor, and promotions that could spike traffic quickly. Marketing was no longer just about nurturing a family-friendly seafood destination over decades. It became a tool to hit quarterly targets, to service interest payments, to keep lenders calm. Here's the pattern interrupt. Endless shrimp had once been a limited-time event, a playful way to drive visits and remind people the chain still had power in the casual dining world. Under the new regime, offers like that started to be evaluated through a harsher lens. How much volume can they push right now? How fast can they move high-margin items? How much immediate revenue can be pulled forward, even if it trains guests to expect more for less? It's an example of what happens when a struggling brand, heavy rent, and financial engineering collide. The pressures would only intensify as new investors and suppliers arrived, and the next owners would take the logic of promotions like endless shrimp even further. With consequences no one around that 2014 boardroom table publicly predicted. There was a time when Red Lobster's biggest problem was finding enough parking spaces on a Friday night. Now the real question was who actually controlled the menu. Because sitting just off stage from those endless baskets of shrimp was a quiet giant, Thai Union. Thai Union isn't a cozy little fishing family. It's one of the world's largest seafood companies, a global empire of tuna, shrimp, and frozen filet that feeds supermarket chains, restaurant brands, and private label products on multiple continents. When a retailer wants containers of shrimp at scale, Thai Union is often the name on the bill. Not only does it sell into grocery aisles, it supplies food service operations that never put its logo on the door, but depend on its volume and price. So when Red Lobster broke away from Darden and later cycled through new owners, Thai Union saw an opportunity. Let me take you back to 2016-2020, when the chain was already under pressure, margins were thin, and the need for a strategic partner sounded comforting. Thai Union didn't just sign a supply contract. It acquired a significant stake in Red Lobster, eventually becoming a major shareholder and planting representatives in the boardroom. On paper, that move sounded efficient. Align the interests of the seafood supplier and the seafood restaurant, lock in stable volume, negotiate better freight and processing, maybe squeeze out a few points of margin. At times inspiring and at times chilling, the pitch was synergy. Less chaos in the supply chain, more predictability in food costs, and a friendly partner who understood shrimp down to the last tail. But suppliers and restaurants live different lives. A supplier wants to sell more product at higher prices on long, predictable contracts. A restaurant wants the opposite: lower food costs, flexible menus, the freedom to pivot away from shrimp if salmon or chicken suddenly makes more money. When the same company sits on both sides of that table, every negotiation turns into a quiet argument with itself. Because of those incentives, the risk wasn't subtle. Red Lobster could stop being a restaurant that happened to buy from Thai Union and start looking like a captive outlet designed to absorb shrimp volume. Menu innovation tilts toward whatever the plant can process cheaply. Promotions lean toward items the supplier needs to move. It's an example of what happens when financial alignment drifts into operational dependence. Now layer endless shrimp on top of that. When the chain considers making a $20 all-you-can-eat shrimp deal permanent, who feels the pull? The operator staring at food cost spreadsheets, or the shareholder supplier that wins every time another plate of shrimp hits the table? When your shrimp supplier is also in the boardroom, the morale of the story changes. An aggressive promotion isn't just marketing anymore, it's strategy. And as the losses mounted, the tension between feeding guests and feeding a global seafood empire would only grow sharper in the decisions that followed. That tension didn't stay in the boardroom. It walked right out into the dining room, onto the plate, and into the lives of regulars who had been coming to Red Lobster for decades. There was a time when the ritual was simple: Big menu, big portions, and the feeling that this was a tiny slice of ocean luxury parked next to a strip mall. Let me take you back to the moment that started to slip. Menus got thinner, literally. The heavy books, with page after page of seafood, slowly turned into slim pamphlets. The higher-end dishes that once justified calling this a special occasion spot, thick lobster tails, towering mixed grills, more adventurous fish, quietly disappeared or came back smaller, with more pasta and less seafood doing the work. Long-time guests noticed shrimp that felt a little smaller, crab that felt a little stringier, cheese biscuits that didn't always land piping hot. Nothing catastrophic. Just enough to whisper that someone, somewhere, was shaving costs. Behind the swinging kitchen doors, the story grew sharper. Because management was chasing lower labor, prep cooks who used to break down fresh product on site were cut back, replaced by more pre-portioned, centralized sourcing designed for efficiency, not romance. Fewer hands meant fewer touches, fewer chances to fix a plate that looked a little sad. Portion guides tightened. A generous scoop became a leveled one, then a scale reading. Servers could feel it in the side-eye when a guest stared at a half-empty plate and wondered what happened to the old Red Lobster. For the accountants, this was progress. Food costs nudged down, labor percentages improved, and each quarter looked a little cleaner. On paper, the empire was becoming leaner, more disciplined, more controllable. But out in the booths, something else was happening. The chain that once felt like an affordable celebration for working-class families, a brush with wealth without the guilt, began to feel like any other coupon-driven casual diner with fewer candles and less magic. The emotional connection that made birthdays and anniversaries land in those red vinyl seats was quietly being traded for margin. And when everyday value feels weaker, marketing has to scream louder. Because the regular menu no longer felt like a deal, the pressure shifted to promotions that could shout over that erosion. Bigger banners, bolder offers, more aggressive promises of endless value. It's an example of what happens when the soul of an experience is trimmed down, while the billboard outside keeps getting brighter. Inside that environment, thinner menus, tighter portions, a shrinking sense of occasion, someone at the table proposed a solution. Take one of the most beloved limited-time offers in the chain's history, a promotion guests waited for every year, and do something no one had dared before. Make it permanent, make it the headline. What could go wrong when endless shrimp never ends? Inside the boardroom, that idea didn't sound reckless at all. It sounded like salvation. There was a time when a bold headline offer could still rescue a struggling casual dining brand, pull lapsed guests off their couches, and turn empty booths into a waiting list. The pitch almost writes itself. Make endless shrimp the hero. Not a side promotion buried in fine print, but the centerpiece of the entire empire. $20, all you can eat, every day. Use it to flood slow Mondays and dead mid-afternoons, to bring back families who hadn't walked through the doors in years, to remind everyone that Red Lobster still existed. In a world of $18 burgers and $6 sodas, a bottomless seafood feast at a flat price feels less like a coupon and more like a dare. On the spreadsheet, the math looked disciplined, even ruthless. Most guests, the models assumed, would tap out after 2 or 3 plates. A few heavy hitters would push harder, but they'd be outliers smoothed away by volume. Along the way, people would order beers, cocktails, maybe an appetizer for the table, maybe dessert for the kids. Margin lost on a third helping of shrimp could be quietly reclaimed through drinks with 80% profit and sides that cost pennies. And this wasn't any shrimp anyway. It was carefully chosen preparations, tightly portioned with negotiated supplier pricing and predictable food costs. From a brand perspective, it almost felt poetic. Endless shrimp was already beloved as a limited-time ritual, the one moment in the year when Red Lobster suddenly mattered again. Let me take you back to those commercials, steaming platters, upbeat music, the promise of abundance. Turning that into a permanent $20 promise looked, on paper, at times inspiring and at times chilling. Inspiring because it signaled value and generosity in a brutal economy. Chilling because it tethered the chain's future to a single aggressive bet on volume. And in the background sat Thai Union, one of the world's largest seafood suppliers, now also a major shareholder, watching a 700-restaurant network that could absorb mountains of shrimp. For a supplier investor, this wasn't just a promotion, it was throughput. More shrimp moving through Red Lobster meant more factory utilization, more revenue, more leverage over the entire supply chain. It's an example of what happens when the line between customer and captive outlet starts to blur. Then came the blind spot. All of this assumed guests would behave like averages in a model, not like highly motivated, extremely online consumers staring at a viral, permanent, all-you-can-eat deal. Once the $20 price was locked in and heavily publicized, people did what people always do with money and food. They optimized. They skipped the drinks, camped at tables, learned which shrimp options had the best yield, and treated the offer not as marketing theater, but as a challenge. The trap had been designed to catch competitors' customers. Instead, it caught Red Lobster's own margins, and the jaws were about to snap shut. The jaws didn't just snap shut on Red Lobster's margins, they snapped shut on human behavior itself. There was a time when endless shrimp was a cute seasonal gimmick, a way to nudge families to order one more appetizer, one more drink, and then quietly leave. But at $20, permanent, and loudly advertised as a bargain, it triggered something much more powerful than marketing. It tapped into a bias that has wrecked many balance sheets before this one. Economists call it the sunk cost effect. Once a person pays a fixed price up front, the money's gone. Rationally, that should be the end of the story. Eat until full, go home. But that is not how life works when a glowing sign screams endless and the receipt shows exactly $20. Diners felt an invisible meter start running in their heads. Every extra plate became a way to drag that per shrimp cost down, to prove they were not the kind of person who lost at a deal. So they pushed one more refill, then another. Not because they were hungry, but because they were optimizing. It's an example of what happens when a company assumes customers will behave like average diners, and instead they behave like amateur accountants with something to prove. Then social media poured gasoline on it. TikToks of people stacking empty plates, Instagram captions bragging about 15 plates for $20, YouTube challenges where groups turned dinner into an endurance test. What had once been a quiet promotion turned into a public scoreboard. The restaurant became an arena. The shrimp became points, and the $20 entry fee was the ticket to compete. Regulars learned the system with almost ruthless precision. They figured out which shrimp options were most filling, which were mostly breading, and which carried the highest value per bite. They learned to order the slowest to cook items first, to keep servers locked into a rhythm of refills, and to avoid cheaper add-ons like salads or sodas that would dilute their victory. In another story, this would be at times inspiring and at times chilling. Here, it was just expensive. Management had expected a neat bell curve. Most guests would eat a modest amount, a few would nibble, a few would feast, and it would all average out. But let me take you back to that TikTok feed, to those Reddit threads, to those plate count screenshots. The reality was not a gentle curve, it was a brutal skew. Heavy users started showing up more often, staying longer and eating far more, while lighter users stayed home. And when that distorted behavior is multiplied across hundreds of restaurants, millions of plates, and a fragile seafood cost structure, the numbers that emerge on the income statement are not just surprising, they are staggering. And for Red Lobster's margins, they would prove deadly. So let's shrink those staggering numbers down to something you can actually picture. One ordinary table on one ordinary night in one ordinary Red Lobster. 4 guests, a family maybe, or co-workers blowing off steam. 2 of them light up when they see the headline, Endless Shrimp, $20. The other 2 play it safe with regular seafood entrees, around $25 each. They add a shared appetizer for $12, 4 soft drinks at $4 apiece, maybe a side salad. On the surface, it looks like money in the bank. Added up, 2 endless shrimp meals, $40, 2 regular entrees, $50, appetizer, $12, drinks, $16. Toss in tax and a modest tip, and the total check is hovering around $130. For a casual chain, on a Tuesday, that's a solid table. There was a time when that was exactly the kind of check managers loved to see. But the story underneath is less generous. In seafood, food cost often lives near 30 to 35% of sales. Shrimp, especially imported shrimp, can spike higher. Those 2 endless shrimp guests don't stop at the first plate. They go for refills, then another, 3, 4, sometimes 5 rounds. Each refill adds more shrimp, more sides, more cheddar biscuits that feel free to the guest, but carry a very real cost. By the time they push their plates away, those 2 $20 deals might be carrying $12 to $15 each in pure food cost, even after aggressive purchasing. That's 60 to 75% food cost on those seats alone, at times inspiring and at times chilling when the target margin needs something closer to 30. The other 2 entrees help, but they're dragged down by the heavy users sitting right next to them. And then there is labor. Endless shrimp is not an efficient meal. Servers make repeated trips for refills. The kitchen fires small batches again and again. Dishwashers handle waves of plates and ramekins. The table lingers an extra 30-40 minutes as the value hunters extract every last shrimp from the deal. That slower turn means 1 fewer table the server can take, 1 less high-margin cocktail the bar might have sold to the next group. Run the math. The table's blended food cost creeps up, labor per guest climbs, and without strong alcohol sales to bail it out, the profitability of that seemingly healthy $130 check can fall below target. It looks like wealth on the sales report and poverty on the P&L. Now let me take you back to that income statement and zoom out, because it's an example of what happens when this isn't a limited time promo, but a year-round habit. Multiply this one table by hundreds of seats, night after night, across a 700-restaurant empire, and the quarterly numbers don't just soften, they crack, and in the next section, you'll see how far the break really spread. Those cracks didn't stay on the page. They showed up in the quarterly filings, in boardrooms, and eventually in bankruptcy court. When Endless Shrimp went from limited time tease to permanent $20 fixture in 2023, Red Lobster didn't just juice traffic, it helped generate an estimated $11 million in operating losses in a single quarter. Not $11 million in sales. $11 million gone, after the rush, after the dishes, after the tips. Because there was a time when a casual dining chain like this lived and died on a handful of percentage points. A typical Red Lobster needed food costs in a tight band, labor in another, and rent sitting quietly in the background. Nudge that food cost line up by just 2 or 3 percentage points across a 700 restaurant empire, and the math turns from thin profit to slow bleed. Think about one unit. If it was making, say, a 5% restaurant level margin on $1 million a quarter, that's $50,000 in operating profit. Push food costs from 30 to 33%, and that margin can vanish. Push it a little higher with shrimp that walks out by the bucket, and the store flips from making money to burning cash just to keep the lights on. Multiply that by hundreds of locations, and the system doesn't wobble. It buckles. But endless shrimp didn't only raise food cost. It rewired how the dining room worked. Guests stayed longer, ordered refills, waited for the next plate. Table turns slowed. Capacity shrank, even as the lobby looked busy. And while those guests were chasing one more round of shrimp, they weren't buying the higher margin entrees, the steaks, the add-on lobster tails that had once carried the weight of the model. That's the compounding effect. Higher food costs on every plate, longer table turn strangling throughput, and quiet cannibalization of the dishes that actually paid the rent. On paper, traffic was up. In reality, the quality of that traffic had shifted toward deal-seeking, low-margin customers at the exact moment the chain needed disciplined, full-check diners to survive. Here's the pattern interrupt. Look at that packed dining room, the endless baskets, the refills, the smiles. Ask a harder question. Is a full house actually a win if every additional guest makes the restaurant poorer? It's an example of what happens when volume is mistaken for value, when the pursuit of attention outruns the pursuit of sustainable profit. His story is one of rising and falling margins more than rising and falling foot traffic. Because of this ruthless math, the promotion that was supposed to save the brand helped push it toward the edge. And in the next section, you'll see how those unit-level losses rolled up into a chain-wide reckoning. Those unit-level losses didn't just vanish inside Red Lobster's walls. They spilled upstream. When the dining room is bleeding money on every plate, the supplier standing behind the buffet line doesn't walk away untouched. Thai Union wasn't some anonymous name on an invoice. It was one of the world's largest seafood companies, a major shareholder, and a strategic partner that had literally bet its own balance sheet on this empire of shrimp. There was a time when the logic seemed flawless. Own a big piece of the restaurant, lock in the shrimp contract, then push volume through a promotion customers couldn't resist. More guests, more shrimp, more revenue, more power. On paper, that story looked clean. In earnings reports, it looked brutal. As endless shrimp went permanent and Red Lobster's finances deteriorated, Thai Union began disclosing the damage. In 2023 and early 2024, the company reported more than $19 million in related losses tied to its Red Lobster exposure. That is not a rounding error. That is the sound of a supplier discovering that volume without margin is just very busy poverty. Yes, Thai Union moved product. Containers of shrimp left ports, invoices were issued, contracts were honored. But as Red Lobster's traffic shifted toward heavy endless shrimp users and away from higher margin dishes, the economics warped. Discount, support, and equity write-downs started to swallow whatever profit sat in the wholesale price. Because of this ruthless math, the partnership that was supposed to guarantee steady wealth for the supplier became untenable. Then came the reputational risk. For a global seafood brand, being tethered to a failing, meme-ified chain is not just a financial footnote, it is a branding problem. Thai Union's leadership had to answer to its own shareholders. Why keep pouring money, time, and credibility into a restaurant that was closing locations, missing rent, and headlining bankruptcy rumors? It's an example of what happens when capital allocation turns into loyalty long after the numbers have delivered their verdict. So in early 2024, Thai Union did something that broke the illusion of control. It announced plans to exit its investment in Red Lobster. After years of trying to engineer a captive customer, the supplier finally stepped back and said, in corporate language, enough. The chain was sinking, and even the shrimp company was climbing off the boat. And that's the irony. The one partner positioned to benefit most from Americans eating heroic amounts of shrimp ended up taking a financial hit, writing down its stake and walking away. At times inspiring and at times chilling, this is what a promotion looks like when it devours not just the restaurant, but the people feeding it. If Red Lobster is losing money on every plate and the shrimp supplier is reporting millions in losses too, who exactly was Endless Shrimp really serving? In the next part of this story, the answer starts to show up in court filings, closed doors, and a long list of creditors left holding the bill. Those court filings didn't just list angry shrimp suppliers and unpaid marketers. They exposed something far heavier wrapped around Red Lobster's neck: rent. Not trendy, negotiable, post-pandemic rent. Locked in, boom time, written in ink rent. There was a time when Red Lobster actually owned a big chunk of its real estate. The buildings, the land, the physical empire of cheddar biscuits and frozen margaritas. Then came the sale-leaseback era. To pull cash out of those walls, previous owners sold hundreds of locations to real estate investors, then signed long-term leases to stay in the exact same dining rooms they had just given up. Money in the door up front, yes. But now, every month, the company had to pay landlords at rates written during better days, when traffic was stronger and margins were fatter. On paper, it sounded clever: unlock the value of the land, redeploy it into growth, keep operating like nothing changed. In real life, it turned fixed rent into a ticking metronome of obligation. Whether a restaurant was packed or empty, whether Endless Shrimp was a hit or a disaster, those lease payments didn't flinch. They arrived, full price on schedule, like a landlord's version of the tide. So when unit-level profitability started to crack, there was no give. Food costs up, labor up, shrimp promos, bleeding cash, and then, on top of it all, a rent bill that assumed this was still 2015. Each location had to earn enough to cover not just ingredients and wages, but those legacy leases, leaving almost no room to absorb promotional losses. A bad quarter didn't just sting, it threatened the entire capital structure. That's where the dominoes began to fall. Underperforming stores weren't just underperforming. Many were trapped in long-term leases with years left and stiff penalties for walking away. Closing a weak restaurant didn't simply mean turning off the lights. It meant triggering buyout clauses, lease guarantees, and angry landlords ready to enforce their contracts. Management hesitated, delayed, tried another menu tweak, another coupon, another Endless Shrimp push. His story is one of numbers that looked flexible on PowerPoints, but turned ruthless when translated into legal obligations. By the time Red Lobster finally filed for Chapter 11 in May 2024, the scale of the trap was public. Over $1 billion in debt and liabilities, a huge share tied to those leases and other long-term promises that no longer matched the reality of the dining rooms. It's an example of what happens when short-term cash needs, optimistic projections, and real estate finance collide with changing consumer habits and a brutal cost environment. Endless Shrimp, at times inspiring and at times chilling in its popularity, was no longer just a mispriced deal. It became the most visible symbol of a deeper strategic corner, a chain locked into its own footprint, bleeding on every plate and running out of exits. And in the next chapter of this story, the people holding those leases start to push back. But there was a time when endless shrimp didn't live on a spreadsheet. It lived in sore feet, in ticket rails jammed with orders, in servers staring at another refill and wondering if the table would even tip 10% on that $20 miracle. Let me take you back to a Thursday night in a composite Red Lobster somewhere in America. The parking lot is full, the wait list is 45 minutes, and the host is cheerfully explaining the promotion for the 15th time. In the dining room, one server has 8 tables, 6 of them on endless shrimp. Plates come back half finished. Guests ask for just one more round because, well, it's free, and the server is sprinting refills, refires, drink orders, and birthday songs while watching the check average sink. The pace is ruthless. The money isn't. By the end of the shift, the steps on the fitness tracker look great. The tip total does not. In the kitchen, the story is one of trays and timers, not corporate strategy. Fryers are maxed out, grills are covered in skewers, and every time a server prints another endless shrimp ticket, the expo sighs and shoves more plates into an already impossible queue. Because the promo is permanent now, there's no ramp up and ramp down, just a constant background hum of chaos. Food comes back untouched, shrimp tossed in the trash, while managers lecture about waste and labor targets in the same breath. It's an example of what happens when a deal is designed in a boardroom and then dropped on a line cook at 7 p.m. Managers stand in the middle of that storm. Corporate wants the promo pushed. Signs at the door, table pitches, upsell scripts. At the same time, the kitchen is in triage, the dish pit is buried, and 2 servers are crying in the walk-in after a brutal double. Labor scheduling turns into guesswork. On endless shrimp days, traffic spikes hard, but not always profitably, so managers staff up to survive the rush, then get chewed out for labor percentages when the check mix tilts too far toward the promo. Too few people, the floor melts down. Too many, the P&L bleeds. Either way, someone loses. Over months, that doesn't just hit the numbers, it hits the soul. There was a time when longtime employees talked about Red Lobster like a career, a family, a place with real pride. Now those same people watch their dining rooms feel cheaper, more frantic, less stable. Rumors of closures move faster than the shrimp refills. A bartender hears that a sister location just shut down overnight. A cook reads about Chapter 11 on a phone during break and wonders how to pay rent if this unit is next. And when one of those restaurants finally does close, the view changes again. No more wait list, no more refills, just a quiet dining room with chairs on tables and a manager doing one last walkthrough. From the street, it's another dark storefront in a struggling strip center. From the back door, where the last employee turns in a key and pulls it shut, what did that slow-motion collapse really look like while guests chased one more plate of shrimp? Out in the dining room, though, it didn't look like collapse. It looked like victory. Social media, filled with photos of towers of shrimp, overflowing baskets of Cheddar Bay biscuits, and captions that sounded less like dinner and more like a heist. Endless shrimp for $20, one post bragged. Challenge accepted. Another tagged a whole friend group. We're hitting Red Lobster this weekend to bankrupt them. It was said as a joke. It was closer to a prophecy. There was a time when endless shrimp felt like a cheat code in real life. People mapped out strategies, shared tips on which flavors were most filling, and bragged about plate counts the way the earlier generations bragged about high scores in an arcade. TikToks walked viewers through how to maximize your $20, recommending light lunches, stretchy pants, and staying until closing. The promotion trained guests to see the restaurant not as a place to relax with family, but as a game to be beaten. Let me take you back to those posts again, because they reveal something deeper. Under the jokes about glitches in the Matrix, there was a clear narrative. Red Lobster was the big corporate empire, the one with money, power, and endless seafood locked away in the freezer. Guests were the underdogs, cleverly extracting as much value as possible before the company caught on. The more plates on the table, the more triumphant the tone. No one was counting margins. They were counting shrimp. Then, almost overnight, the feed changed. Instead of overflowing tables, there were photos of dark ones, locked doors, handwritten signs taped to glass that read, "Closed permanently," or "Thank you for 25 years." The same people who had joked about taking them for everything they've got were now posting about losing the place where they celebrated birthdays, graduations, and awkward first dates over crab legs. "This was our spot," one comment read. "My parents brought me here as a kid. Now it's just gone." Most of those guests never knew that the beloved $20 deal they celebrated was one of the very reasons their local store couldn't keep the lights on. The promotion that packed the lobby also packed the income statement with red ink. Endless shrimp pulled in traffic, but a portion of that traffic was ruthlessly unprofitable, lingering for hours, ordering refills that cost more than the entire check. It's an example of what happens when human behavior overwhelms a spreadsheet. His story is one of misread incentives. Theirs is one of misread signals. Consumers are trained to cheer for hacks, to hunt for glitches, to celebrate the rare moment when corporate wealth seems to pay them back. The long-term life of the business rarely enters the picture. If the deal is on the menu today, the assumption is that someone, somewhere, has done the math. But behind those locked doors, another group had already started doing very different calculations. Beyond guests and staff, there were landlords staring at empty units, franchisees staring at loans, and suppliers wondering if they would ever be paid. While customers chased one more plate of shrimp, these quiet partners were bracing for impact, and their reaction would turn a restaurant promotion into something far more dangerous. Those quiet partners weren't staring at an abstract spreadsheet problem. They were staring at real buildings. Red Lobster didn't just rent anonymous boxes on the edge of town. For decades it claimed the corners, end caps on busy strip centers, freestanding pads by the highway exit, big, confident footprints near malls where the parking lots once filled every Friday night. There was a time when a Red Lobster sign was a small event in the life of a suburb. It meant a sit-down dinner option, a place for birthdays and work parties, a signal that this intersection had finally made it. Landlords loved that. A national brand, multi-decade leases, predictable money. The chain became a kind of casual dining anchor, pulling traffic to neighboring tenants who happily paid their own rent in the glow of that red script and fake lighthouse decor. So when roughly 100 locations went dark in a matter of days, the shockwave was immediate. One week, a landlord has a full-paying tenant with corporate backing. The next, the doors are chained, the lights are off, and a 6,000 to 8,000 square foot restaurant box is bleeding cash instead of generating it. No rent, no percentage of sales kicker, just property taxes, maintenance, and the quiet sound of an empty parking lot. And these weren't generic rectangles that could easily become anything. Many sites were tailored to Red Lobster's exact footprint: oversized kitchens, specialized ventilation, seafood prep areas, bar layouts, brand-specific facades, even that distinctive roofline. Converting that into a bank branch, a medical clinic, or a gym is possible, but it is not cheap, and it is not fast. Every month spent finding a new tenant and ripping out the old empire of shrimp is another month of negative cash flow. Because of that design, re-tenanting becomes a negotiation between time, money, and power. drop the rent to lure another restaurant, spend heavily to gut and rebuild for a non-restaurant user, or let the building sit and hope the market recovers. In strong trade areas, some landlords will eventually win that bet. In weaker corridors, especially those already hollowed out by dying malls and retail closures, the odds look far worse. This is where the story stops being about one chain and starts being about an entire financial ecosystem. Many of these properties sit inside big portfolios owned by REITs, insurance companies, even pension funds. The same retirement money that once loved a safe, long-term Red Lobster lease now has to explain why a stable asset suddenly needs millions in capital just to be leasable again. Pattern interrupt for a second. A $20 endless shrimp deal sounds like a goofy promotion played out in one noisy dining room with a few guests pushing their luck on plate number 5. Yet, that single decision, multiplied across hundreds of locations, helped trigger closures that ripple into bond covenants, loan defaults, and quarterly reports for institutions that never served a single basket of Cheddar Bay biscuits. It's an example of what happens when thin restaurant margins collide with highly leveraged real estate. One bad bet on traffic, one misread of human appetite, and the damage doesn't stop at the kitchen door. It moves outward through landlord, lenders, and investors until entire shopping centers have to reinvent themselves or quietly decay. And for the next group in the blast radius, the pain would be even more personal. For the people holding Red Lobster leases, the collapse meant dark dining rooms and empty parking lots. For the people feeding those dining rooms, it meant something harsher, orders vanishing overnight and money that never arrived. Because when a 700-restaurant seafood empire goes down, it drags a whole hidden fleet with it. There was a time when the Red Lobster supply web looked almost invincible. Thai Union handled oceans of shrimp, yes, but wrapped around that core were hundreds of regional and specialty suppliers. Bakeries that made those cheddar biscuits to exact specs. Beverage distributors routing kegs and branded lemonades. Produce companies washing lettuce by the ton. Linen services, grease haulers, pest control, point-of-sale technicians, even the small family print shops churning out menus and table toppers. Together, they formed a quiet army, all calibrated to the chain's weekly rhythm. Then the rhythm stopped, when nearly 100 locations went dark and traffic cratered at many of the rest. Volume didn't just dip, it fell off a cliff. A giant like Thai Union could write down tens of millions and move on. The small regional seafood processor that had just hired 10 extra workers for a new Red Lobster contract could not. Invoices from closing stores sat unpaid. Credit terms that once felt safe suddenly looked reckless. Cash that was supposed to arrive in 30 days never did. Because of that sudden break in the chain, vendors with thin margins and even thinner bank accounts had to make brutal choices. Some delayed paying their own fishermen or farmers. Some maxed out credit lines to cover fuel and payroll, gambling that bankruptcy court would eventually spit out a check. Others simply shut the doors. It's an example of what happens when one company's traffic gamble becomes everyone else's solvency crisis. Many of these suppliers hadn't just sold to Red Lobster, they had reshaped their lives around it. A packaging plant might have bought a new line dedicated to frozen shrimp trays in Red Lobster branded dimensions. A trucking firm might have leased extra reefers, timed for those weekly deliveries. A sauce manufacturer could have invested in tanks sized for a proprietary cocktail sauce formula. Now those assets sit underutilized. The equipment still humming, but the orders a fraction of what they were. And the shock doesn't stop at the warehouse door. When volumes collapse, line workers at processing plants lose shifts, then jobs. Drivers see routes cut. Local cleaning crews, HVAC contractors and repair technicians who once lived off regular service calls find their calendars suddenly, ominously open. His story is one of oil and railroads. This story is one of shrimp and supply chains, but the pattern is eerily similar and at times inspiring and at times chilling in its efficiency. Let me take you back to the dining room for a moment, because here's the cruel irony. Guests walk out after paying $20 for endless shrimp, thinking the deal ended when the receipt printed. For the people in those supply chains, the bill is still coming due. When a 700-restaurant chain stumbles, it doesn't fall alone, and the workers tied to its orbit feel the impact long after the last shrimp is served. But the real shock came when everyone looked up from the shrimp trays and realized something uncomfortable. Red Lobster wasn't just one company. It was an entire web of owners, operators, and partners, all wearing the same uniform, all about to get drenched by the same storm. There was a time when the brand was simple to understand. Headquarters in the US controlled hundreds of corporate-owned restaurants, while a smaller ring of franchisees and international partners ran locations in Canada, Mexico, Asia, and the Middle East. On paper, that mix spreads risk. In practice, when a 700-restaurant empire catches fire in public, the flames don't stop at the corporate border. Franchisees woke up to headlines screaming bankruptcy, viral photos of shuttered units, and customers asking the same question at the host stand: "Are you closing too?" Some of these operators had healthy sales, stable teams, even decent wealth tied up in their locations. Yet overnight, their life's work was trading under a damaged name, as if every dining room had personally drowned in endless shrimp losses. Because of the Chapter 11 filing, the brand's national marketing machine suddenly sputtered. Corporate pulled back, renegotiated, delayed. TV campaigns went dark or vague. Social media shifted from glossy lobster feasts to legal statements and crisis messaging. For a franchisee paying royalties, that felt like paying for a billboard that now advertised fear. The promise had been unified marketing, powerful branding, a rising tide. What they got was a leaky umbrella. Then came the quieter pain. Standardized supply chains that once delivered the same shrimp, biscuits, and sauces to every unit became harder to guarantee. Vendors, spooked by more than $1 billion in listed liabilities, tightened terms, demanded cash, or exited. A well-run franchise in a suburban plaza could still find its deliveries late, its menu suddenly missing a key product, its guests wondering why the endless part now had very real limits. International partners watched US chaos from a distance that didn't feel distant at all. Local diners in Dubai or Toronto might never see a Florida bankruptcy court, but they saw the same viral memes, the same Red Lobster is dying headlines. Some partners had invested millions to plant the brand in new markets, trusting that American corporate power would anchor the system. Now they had to ask whether they were building on sand. His story is one of power and vulnerability colliding, at times inspiring and at times chilling, because it shows how even a global restaurant empire can't fully shield its farthest outposts when the center stumbles. It's an example of what happens when a promotion goes wrong inside a business model already under stress. While franchisees and partners scrambled to hold the line, analysts were whispering a different question. Was endless shrimp the real problem, or just the most dramatic symptom of a deeper disease eating away at casual dining itself? Casual dining as an idea once looked unshakable. Big booths, friendly servers, sizzling plates marching out of the kitchen like clockwork. There was a time when that model felt like the safe middle of American restaurant life, wedged neatly between fast food on one side and white tablecloth luxury on the other. But while Red Lobster was drowning in shrimp, the tide was going out on the whole category. Start with the pressures no brand can escape. wages are rising as labor markets tighten and minimums climb. Rents have surged in the very shopping centers and highway exits where these chains built their empire. Delivery apps take 20 to 30% off the top, turning already thin margins into a magic trick where the money disappears. And the customer has changed. People now chase speed, price, or spectacle. Fast casual lines move quickly. Food halls feel like events. And younger diners would rather buy an experience than a heavy entree that lands like a brick. Because of those shifts, Red Lobster's story is one of many, not an isolated disaster. Ruby Tuesday quietly shuttered locations until malls felt haunted. Applebee's and Chili's have closed hundreds of units, pruning their networks just to keep average volumes alive. TGI Fridays has been sold, reshaped, and downsized. Even icons like Cheesecake Factory have pulled back expansion and leaned on smaller formats. Bankruptcy courts have seen a parade of casual brands walk through their doors, all telling versions of the same story. Sales wobble, costs climb, debt lingers, and the math no longer forgives mistakes. At the center of that math sits the traditional casual dining blueprint. Large dining room, sprawling kitchens, lots of staff, full service at every table. It's a beautiful machine when every seat is filled and every guest orders an appetizer, a big entree, maybe dessert. But when traffic softens, that fixed cost base doesn't shrink. The air conditioning still runs, the lease still hits, the line cooks still clock in. Keeping prices at a level the middle class can afford while paying modern wages and rent turns into a slow, grinding squeeze. Seafood magnifies the pain. Ingredient costs fluctuate with weather, fuel, and global supply. A shrimp plate that made sense at one price point can quietly become a liability as wholesale prices move. Endless shrimp in that environment was not just a fun gimmick. It was an extreme attempt to hack demand inside an economic system already deteriorating, a bet that sheer volume and traffic could overpower structural weakness, the way a louder engine masks a failing transmission. So here's the pattern interrupt. Was Red Lobster uniquely reckless, or simply the first big name to pay the public price for a business model, past its prime? From one angle, the $20 all-you-can-eat deal looks absurd. From another, it looks predictable, almost inevitable. When an entire category is trapped between rising costs and changing tastes, promotions become more desperate, menus get more distorted, and leaders push harder on whatever still moves the needle. The question now is whether other chains quietly facing the same physics can adapt in time, or whether Endless Shrimp was just the opening act. There was a time when endless didn't sound like a death sentence for a restaurant. It sounded like a celebration, a party where the house somehow still made money. To see that, you have to look at the chain that turned bottomless carbs into a weapon, Olive Garden. Let me take you back to the heyday of never-ending pasta. On the surface, it looked just as reckless as Endless Shrimp. Pay a flat price, eat all the pasta you want, come back tomorrow and do it again. But under the tablecloth, the economics were completely different. Pasta and sauce are some of the lowest cost items in casual dining, dry product that sits in the pantry, boils in minutes, and lands on the plate with a predictable margin that accountants dream about. Because of that predictability, Olive Garden's life in promotion season looked almost calm. A bowl of fettuccine, a ladle of Alfredo, a sprinkle of cheese. The chain could refill plates all night and still keep food costs under tight control. Shrimp, by contrast, lives in a world of volatile global supply, weather, disease, and currency swings. Every refill is a fresh bet on commodity markets. Every extra portion is another chance for money to quietly leak out of the empire. Operationally, never-ending pasta was a gift to the kitchen. One course starch, a handful of sauces, a few simple toppings, all running through the same line. Fewer cooking steps, less timing risk, almost no plate-to-plate cost variability. Cooks could move fast, servers could turn tables, and the back of house didn't have to juggle 5 different shrimp formats, fryers, grills, and precise cook times just to keep the promise of endless alive. And Olive Garden's menu was built to surround that bowl of pasta with higher margin power. Breadsticks, salads, appetizers, desserts, and especially drinks quietly carried the check upward. A cheap base on the plate, more expensive add-ons in the glass. The promotion pulled people in with the illusion of beating the house, while the real money came from refills of soda, another glass of wine, a family order of calamari placed, while everyone waited for the next round of noodles. Crucially, never-ending pasta was never allowed to become the chain's permanent identity. It was a limited-time, carefully managed traffic driver, flipped on and off like a switch when the numbers made sense. That restraint mattered. It's an example of what happens when leadership understands that endless is a tactic, not a lifestyle. The contrast is at times inspiring and at times chilling. Endless itself isn't fatal. The danger begins when a brand misprices what's endless, misjudges how guests will behave, and most dangerously, forgets to decide when the party finally ends. The next part of the story shows what that looks like in practice. Endless, by itself, isn't the villain. To see that, look at a chain that turned all you can into a subscription and quietly rewired its entire business. There was a time when Panera wasn't a tech-forward loyalty machine, just a bakery cafe selling soup and bread bowls. Then leadership asked a different question. What if endless didn't live on the plate, but on the calendar? Panera's unlimited sip club is simple on the surface. Pay a fixed monthly fee and get endless coffee, tea, and certain fountain drinks every single day. No coupons, no fine print, no roulette wheel of limited time offers. The promise is routine. Stop in on the way to work, refill in the afternoon, maybe grab one more on the weekend. In return, Panera gets something more valuable than a crowded Tuesday night. It gets recurring money, predictable traffic, and a direct line into each guest's life through an app and a membership. Behind that calm exterior is a cold calculation. Coffee and soft drinks are cheap, stable, and astonishingly forgiving. The cup, the lid, the ice, the beans, the syrup, the labor to pour it. Even when a guest drinks every day, the hard cost per month stays low and remarkably predictable. Heavy users don't blow up the model, they define it. Their loyalty smooths the revenue line, while the real profit quietly comes from the pastry, the breakfast sandwich, the salad grabbed while you're here. So Panera uses endless as bait, but not as the meal. Endless beverages anchor a loyalty program, drive frequency, and create a habit loop that points customers toward higher margin food. It's an example of what happens when a brand aligns what's endless with what's cheap, controllable, and strategically useful. The subscription isn't charity, it's a funnel into an empire of soups, sandwiches, and impulse cookies. Now let me take you back to Red Lobster's dining room, where the logic ran in reverse. Endless shrimp wasn't a monthly subscription smoothing out cash flow, it was a per-visit, per-guest gamble. Every time a heavy user walked through the door, the meter started running on real seafood, real labor, and a real seat that couldn't be sold to someone paying full menu price. There was no recurring revenue base building quietly in the background, only a series of one-night stands paid for with shrinking margins. Panera treated endless as a loyalty tool wrapped around beverages with low cost and high predictability. Red Lobster turned endless into the main event on an already tight P&L, tied to a volatile commodity whose price it didn't fully control. One chain used bottomless drinks to sell more food. The other used bottomless shrimp to sell more shrimp. If Panera can make endless work, and other brands can too, then the question becomes harder and far more uncomfortable. What exactly went wrong inside Red Lobster's boardroom when they decided their future depended on all-you-can-eat shrimp? The answer starts with who was sitting at the table and what they secretly needed from every shrimp on that plate. In that boardroom, the math didn't start with shrimp. It started with fear. Declining traffic, rising leases, a 700-restaurant empire built on mid-tier seafood, while casual dining as a whole was bleeding out. There was a time when being America's seafood restaurant printed money. By 2023, it barely paid the interest. Leadership was being squeezed from every side. Lenders wanted a story about growth, not survival. Owners wanted a plan that sounded bold enough to justify staying in the game. Operators in the field wanted relief from years of cost-cutting that had hollowed out the experience. Endless shrimp at $20 looked like a way to answer everyone at once. Traffic for the restaurants, a dramatic headline for investors, and for Thai Union, a path to move a lot more shrimp through its struggling partner. On paper, the early numbers cooperated. Same-store sales ticked up. Dining rooms felt busy again. Traffic counts, guest waits, social media buzz. All the fast, flattering metrics lit up green. The slower, deadlier indicators moved quietly in the background. Food cost percentages creeping higher. Overtime hours to keep up with refills. Checks that stubbornly refused to grow because guests camped on shrimp instead of ordering higher margin add-ons. This is where short-term metrics become a kind of narcotic. As long as the weekly dashboard showed more bodies and seats, it was easy to wave away the erosion happening underneath. Margin compression, brand dilution, a subtle shift from special seafood dinner to cheap endless plate, those show up in quarters, not days. And by the time they show up, careers are already tied to the bet. Inside that room, optimism, bias did the rest. Executives told themselves that with enough operational tweaks, smaller shrimp, faster turns, tighter portion controls, clever menu engineering, any early margin pain could be massaged away. His story is one of ruthless efficiency would have sounded familiar to anyone who studied Rockefeller. Here, the hope was that ruthless efficiency could make an obviously dangerous offer safe. It's an example of what happens when belief in control overpowers respect for risk. Then there was the quiet gravitational pull of Thai Union, one of the world's largest seafood suppliers, sitting not just across the table as a vendor, but inside the ownership structure. No one had to say, "Make shrimp the hero." The incentives said it for them. A shrimp-centric answer to a traffic problem suddenly felt elegant, synergistic, even inevitable. Let me take you back to that subtle conflict. Every extra plate of shrimp that helped Thai Union's volume also deepened Red Lobster's exposure to one fragile, heavily discounted product. But in a room full of smart people who was responsible for asking the most basic, pattern-interrupt question. What if we're wrong about how much shrimp people will eat? What if the very guests this chain had trained for decades to chase value treated endless, not as a teaser, but as a challenge? The next part of this story shows what happened when that hypothetical walked through the front door and sat down to order. That hypothetical did not stay hypothetical for long. In 2023, Red Lobster took endless shrimp, a limited-time stunt that had always been safely fenced in by calendar dates, and made it permanent at $20. Not only did the promotion become the new face of the brand, it quietly became the gravitational center of the entire menu. Let me take you back to that first full quarter after the decision. There was a time when a promo like this meant a short spike in traffic, a few bloated food costs, and then life went back to normal. Instead, the guest mix shifted. People were coming in, sitting down, and treating endless as a mission. 3, 4, 5 refills. Cheddar Bay biscuits as carb loading for the shrimp marathon. Revenue looked healthy, but plate costs were creeping higher than the planners had modeled. Inside the corporate offices, the numbers triggered the first debates. Traffic is up, margins are down. Do they pull back and risk empty dining rooms again, or lean in and hope they can fix the math with portion controls, menu engineering, and a quiet price bump later? On paper, the answer seemed obvious: ride the wave. In reality, every extra shrimp on every extra plate was eroding profit in slow motion. By the next quarter, the pattern hardened. Servers were swapping stories of guests bragging about beating the restaurant. Social media loved it. The promotion was at times inspiring and at times chilling. Inspiring for customers who had just found the cheapest seafood party in town. Chilling for anyone who understood food costs on imported shrimp. Somewhere in those meetings, someone pointed to the ad spend, the billboards, the TV spots, the menu boards. Too much money had gone in. Too much brand equity was now tied to those two words: endless shrimp. Pulling back carried its own danger. Reverse course too fast, and the chain looks desperate, untrustworthy, even weak. Guests who had built new weekly habits around that $20 feast would not quietly accept a price jump or a sudden disappearance. It's an example of what happens when a marketing win turns into a psychological contract. Break it, and the betrayal lives on in every angry post, every "they used to be good" story told to friends and family. Quarter after quarter, sunk cost thinking dug the hole deeper. His story is one of empire and power. Theirs became a story of spreadsheets and denial. Executives had committed time, money, and the future of a struggling 700-restaurant chain to this one bet. Admitting the mistake early would have meant confessing that the traffic was a mirage, that the apparent recovery was built on selling too much food for too little cash. Finally, the bill arrived. One quarter alone showed an estimated $11 million operating loss tied to endless shrimp. By the time the truth was undeniable, Red Lobster was no longer arguing about a promotion. It was fighting for survival in bankruptcy court, with landlord, suppliers, and thousands of workers about to feel what endless really meant. In May 2024, the bill finally took legal form. A Chapter 11 bankruptcy filing and a public admission that the empire was broken. Not quietly, not behind closed doors, but in a federal court where every bad lease, every failed promotion, and every unpaid invoice would be dragged into the light. Chapter 11 is not a death certificate. It is a hospital ward. It allows a company to keep breathing, to keep the lights on and the kitchens running, while it tells judges and creditors, "Give us time, or you get even less." Red Lobster wasn't being liquidated overnight. Guests could still walk in, crack a biscuit, and order shrimp. But now every plate was being served under court supervision. The filing spelled out the damage. Roughly 100 locations shut down almost overnight. Dining rooms cleared out not by lack of customers, but by legal notice. More than $1 billion in debt and liabilities listed in black and white. Unpaid rent, supplier bills, loans stacked on loans. There was a time when a brand like Red Lobster represented safe, middle-class seafood wealth. Now it was a spreadsheet of obligations no one wanted to own. Inside the courtroom, the drama shifted from endless refills to finite claims. Creditors lined up, from global shrimp suppliers to the company that printed the menus. Landlords argued over leases that had once seemed like guaranteed money, but were now anchors dragging them down. Some wanted their buildings back. Others begged the judge to keep locations open because a half-paying tenant was still better than a dark, empty box. Across from them sat management and restructuring advisors, armed with binders and PowerPoints, trying to prove there was still a viable core business buried under the wreckage. The plan: shed the worst leases, renegotiate the rest, convert mountains of debt into equity, and shrink the chain to a smaller, supposedly profitable life. In theory, this is what Chapter 11 promises: a second chance if everyone agrees to take a haircut. But the real story in that room was about how it all went wrong. Promotions like Endless Shrimp suddenly became exhibits, not just marketing ideas. Lawyers and creditors pointed to them as symbols of mismanagement, misaligned incentives, and strategies that chase traffic at the expense of money. It's an example of what happens when power, pressure, and wishful thinking override basic math. Because of those decisions, thousands of workers and franchisees and suppliers were now asking the same question the judge had to answer. What, if anything, can be saved from this once dominant seafood empire? And as the doors of the courtroom closed, another quieter question hung in the air, one that the next phase of this story would finally confront. There was a time when the Red Lobster name alone could pull a family minivan off the highway. Not because it was the cheapest meal in town, but because it meant something: a birthday, an anniversary, a rare night when the good clothes came out and the kids were warned not to spill cocktail sauce on the tablecloth. Underneath the bankruptcy headlines, that emotional muscle hasn't vanished. National name recognition still has power. Even people who haven't walked through those doors in years can picture the red script, the tanks, the platters, and above all, they remember the one thing the company never managed to ruin with financial engineering: the Cheddar Bay biscuits. Those biscuits became a shared memory, a small edible ritual that anchored the brand in millions of lives. In a landscape of interchangeable chains, that kind of nostalgia is hard to manufacture and even harder to kill. So if the old empire is being dismantled in court, what actually survives? Not 700 locations, certainly, but a leaner, restructured Red Lobster could trade bigness for health, closing weak stores, keeping only the sites with real demand, favorable leases, and managers who know how to run a tight ship. Fewer dining rooms, stronger unit economics, less chasing traffic at any cost, more discipline about what each plate has to earn to pay for seafood, labor, rent, and, yes, those biscuits. That kind of reset would also force a deeper question: who is Red Lobster for now? The chain lost its way when it tried to become a permanent, all-you-can-eat buffet for extreme value seekers, inviting guests to sit for hours and mine $20 endless shrimp like it was a personal arbitrage trade. A repositioned brand would walk back from that cliff and lean into quality and occasion again, treating shrimp as a highlight, not a dare. Smaller menus, fresher product, clearer price signals, less casino, more dinner. And beyond the U.S. courtroom, the story is different. Many international and franchise markets operate on separate balance sheets, with local partners who still see steady traffic and profitable nights. In those places, the sign doesn't read distressed asset. It still reads seafood restaurant. The brand's presence in Canada, Asia, the Middle East can continue almost untouched, a reminder that the logo itself wasn't the problem. The problem was how the American owners chose to use it. So even if the endless shrimp era finally ends, its shadow lingers. Because this isn't just a tale about one promotion gone wrong. It's an example of what happens when greed, mispricing, and wishful thinking about human behavior collide. And the most revealing part of that story is still coming. Because endless shrimp looked generous, it was easy to miss what it really was. Not a gift, but a gamble. The bet was simple and a little ruthless. Most people, the executives assumed, would tap out after 2 or 3 plates, would get full-on cheap sides, would talk more than they ate. The house would win, quietly, plate after plate. There was a time when all you can eat meant a buffet line and a clear understanding that the restaurant still held the upper hand. Here, the illusion went further. Endless shrimp wrapped that same old calculation in warmth, in the story of a family dinner, in the comfort of a $20 price tag that felt almost nostalgic. Behind the scenes, spreadsheets modeled human appetite as a predictable curve. The generosity worked only if customers behaved exactly as planned. But ambition rarely stops at one lucky roll of the dice. Once Red Lobster had trained Wall Street to watch traffic counts and promotion buzz, each quarter demanded a new spectacle. 2 shrimp flavors became 5, limited time offers became seasonal rituals, and then, under Thai Union's watch, the ritual became permanent. Not only was it a $20 promise of abundance, it was a standing invitation to test the limits of the business model. Every time the promotion was pushed harder, the brand gave up something. Margin here, pricing power there, a bit of mystique washed away in endless refills. It's an example of what happens when a company chases short-term growth by stretching the very idea that made its empire feel special. Because of that hunger for numbers, the restaurant that once sold celebration began selling volume. And buried inside was a moral tension no billboard mentioned. The marketing spoke of endless value, but the economics depended on quiet constraints. Smaller shrimp, slower refills, careful portioning, hoping most guests would never really cash in on what the words implied. The life of the promotion was built on a strange hope that customers would not fully take what they had been promised. Then something shifted. People stayed longer. They ordered that extra plate. Social media turned endless shrimp into a challenge, not a courtesy. The illusion cracked, and the check finally came due. An $11 million operating loss in 1 quarter, mounting debts, and a 700-restaurant chain suddenly revealing how fragile its wealth and power really were. So the irony lands hard. In chasing the image of endless value, Red Lobster exposed its limits. At times inspiring and at times chilling, the story forces a question that reaches far beyond seafood. The next time an airline sells unlimited flights, a telecom promises unlimited data, or a restaurant offers endless anything, let me take you back to those overflowing shrimp plates. Whose ambition are you really looking at, and whose risk is quietly piling up in the background? Because this promotion was not an accident, it was a pattern. And that pattern did not end with shrimp. So how do you actually read a deal like that in real life before it explodes on someone's balance sheet? Start with a brutal little rule. If a deal looks obviously unprofitable at face value, assume there's a catch. Not a conspiracy, a mechanism. Somewhere, the business is limiting portions, limiting time, or making the money back on everything wrapped around the bargain. There was a time when all you can eat meant heroic generosity. Today, it usually means the house has quietly done the math and expects to win. Think about endless shrimp through that lens. $20 for plate after plate of seafood that has to be farmed, processed, shipped, cooked, and served by paid workers in a building with rent, electricity, and insurance. Even without seeing Red Lobster's books, the unit economics whisper a warning. Shrimp is not free, labor is not free. A table locked for 2 hours by one guest on a marathon mission is not free. So the question becomes, how many customers like that can a business survive? Not in theory, in cold numbers. If it costs several dollars in product and labor per plate, and a heavy user can put away 5, 6, 7 rounds, the margin on that guess vanishes and then turns negative. Multiply that by a wave of people who saw the same viral TikToks, and an empire of 700 restaurants starts to feel very fragile. Behind the scenes, there are standard playbooks. Loss leaders are offers designed to lose money on purpose in order to drive traffic and make it back elsewhere. Cheap wings so you'll buy expensive drinks. A free trial so you'll forget to cancel. It's an example of what happens when a razor-thin promotion is treated as a permanent pillar instead of a temporary lure. Then there are subscription models, unlimited coffee for a monthly fee, streaming libraries for the price of one DVD. These smooth out revenue, hide volatility, and rely on most people underusing what they bought. Upsell structures do the same thing. The entree is low margin, the sides, desserts, and drinks are where the wealth appears. But when too many customers learn to hack the system, the math flips. Power users dominate. The quiet subsidy from light users disappears. At times inspiring and at times chilling, the response is almost always the same. The rules change. Portions shrink. Time limits appear. Unlimited quietly gains an asterisk, or the business finally collapses under its own promises. Endless Shrimp is a vivid food story, but the pattern doesn't stop at the table. The same logic haunts streaming platforms bleeding cash, banks offering high-yield teaser rates, and tech startups chasing growth at any cost. And in Red Lobster's case, that logic wasn't abstract. It showed up in quarterly losses, desperate boardrooms, and one decision that would push the chain right up to the edge. Because the real danger wasn't just the deal. It was who needed that deal to work next. That same logic is everywhere now, hiding in plain sight behind glossy apps and slick ads. There was a time when endless sounded like a gift. Today, it's a business model, a bet on human nature, and at times inspiring, and at times chilling in how far leaders will push it. Let me take you back to the streaming wars. Not only do platforms promise tens of thousands of hours of movies and shows, they do it for less than the price of a single theater ticket, while spending billions on original content, global marketing, and tech. The empire they chase is subscriber growth, not profit. So they burn money, underprice their libraries, and pray that one day, when everyone is hooked, prices can quietly rise and costs can finally be tamed. It's an example of what happens when executives convince themselves that average behavior will save them. They model that most viewers will watch a few hours here and there, that churn will be manageable, that password sharing can be addressed later. But then reality walks in like a table of shrimp fanatics. People binge entire seasons in a weekend, cancel the moment a favorite show ends, and jump between platforms chasing free trials and promos. Some services lose billions trying to keep up, and the dream of endless content starts to look a lot like Endless Shrimp with better branding. The same temptation haunts money itself. Fintech apps and hungry banks dangle high-yield savings accounts, cashback cards, and sign-up bonuses that feel like free wealth. 4%, 5%, more, all wrapped in sleek design and a friendly tone that promises a better financial life. Yet behind the scenes, those offers only work if most customers behave like the models. Leave big balances, rarely withdraw, accept lower rates later, and eventually buy the profitable products. When that doesn't happen, the mask slips. Rates drop overnight, fees appear in the fine print, rewards devalue. The early generosity was never permanent. It was a promotional flare, lighting the sky just long enough to raise the next funding round or impress the next acquirer. Because of that ruthless focus on growth, some companies end up with the same problem as Red Lobster, A customer base trained to love a deal that no longer makes sense. Even telecom, an industry built on wires and towers, sells the dream of infinity. Unlimited data, all-you-can-stream mobile plans, promises that you can scroll, game, and watch without thinking. But heavy users hammer the network, costs spike, and suddenly the fine print wakes up. Throttling, deprioritization, soft caps. The plan was only unlimited as long as too many people didn't treat it that way. In every case, leaders are betting on restraint, on averages, on the hope that human appetite will politely stop just before the profit margin. Sometimes that works. Sometimes, like Red Lobster, they guess wrong. So the next time an ad or pitch deck whispers about something unlimited, endless, or all-you-can anything, pause for a second. Ask whose Chapter 11 filing you might be getting an early preview of, and whose balance sheet is quietly praying you don't go back for another plate. Because the bill always comes due, the only question is who pays it, and how loud the crash will be when the fantasy ends. So what do the survivors do, the chains that stare at the same temptation, and somehow don't drive their empire into a ditch? There was a time when all you can eat was everywhere in American dining, yet only a few names ended up in Chapter 11 court. That contrast is not an accident. It's an example of what happens when discipline quietly beats spectacle. Disciplined operators treat promotions like experiments, not destiny. They launch in a few markets on slow nights with tight rules. Then they track everything, not just traffic, but margin per guest. How many high-cost items walk out the door? Which menu categories get cannibalized? How long tables sit occupied by one heroic plate stacker? If the math turns against them, they do something Red Lobster refused to do. They kill the offer quickly and move on with barely a sentimental goodbye. Look at chains like Olive Garden or Chili's when they run never-ending or bottomless deals. The language is grand, the economics are not. The price changes by daypart or location, refills slow down after a certain point, and the most expensive components quietly shrink while the cheap anchors expand. Dynamic pricing, portion control, and menu engineering work together, steering guests toward profitable choices without making anyone feel cheated, just pleasantly full. This is where power and restraint meet. Smart menus make the most profitable items easy to say yes to, with big photos, combo bundles, and add-aside prompts that feel generous but protect the margin. The heavy-cost dishes are there, but a little harder to stumble into. His story is one of invisible nudges, not loud dare you to bankrupt us promises. Behind the scenes, the incentives are aligned. The supplier sells shrimp, but does not sit in the owner's chair deciding how recklessly to move volume. Boards tie executive bonuses to unit-level profitability, repeat visits, and cash flow over years, not just a one-quarter spike in traffic. When a promotion starts attracting the wrong guest mix, people who come 3 times a week, order only the loss leader, and leave no dessert or drink money behind, the alarms ring before the lenders do. Plenty of chains have quietly retired or restructured endless offers once abuse showed up. Olive Garden tightened its never-ending pasta bowl, moving it back to limited windows, raising prices, trimming options, and telling guests exactly why. Some buffet brands added weekend surcharges, time limits, or premium upcharges, explaining that food costs and waste had changed. The transparency preserved trust, even as the fantasy shrank. And here's the pattern interrupt. Generosity in business is not about promising endless anything. It's about offering enough, profitably, that the doors stay open for the next generation of families who want a birthday dinner, an anniversary, one small taste of wealth in a life that often feels closer to poverty. The fairest deal is the one that survives long enough to be offered again tomorrow. But here's the haunting question lurking under that fair deal. Did endless shrimp really have to die? Or was there a version that could have lived? There was a time when all you can eat didn't mean all the margin you can burn. The concept could have been framed like a disciplined budget, not an open bar. Imagine a tiered model, a higher headline price, say $25 or $30 with clear lanes. Standard shrimp dishes truly endless, but the premium, high-cost options capped at 2 or 3 plates. The core stays generous, the wild outliers get fenced in, and suddenly food costs stop behaving like a casino. Let me take you back to how other chains have survived this game. They quietly nudge customers into profitable behavior. Olive Garden's never-ending pasta bowl, cheap carbs, predictable portions, add-ons everywhere. Red Lobster could have mirrored that logic. Endless shrimp on select lower-cost preparations, while the more expensive scampi or grilled skewers required a small upcharge or came with a hard limit. Not a retreat from generosity, just a reminder that even in a seafood empire, money still has rules. Then there's the check average. A $20 bottomless entree with water and nothing else is a slow-motion disaster. Tie endless shrimp to a required drink or appetizer, and the math changes fast. Endless shrimp with any $6 beverage, or endless shrimp plus one shareable starter for the table. Suddenly, the promo isn't a freeloader magnet, it's a bundle. The guest feels clever, the table looks full, and the restaurant quietly earns back its margin one cocktail and one artichoke dip at a time. Timing could have been another pressure valve. Weekday only. Off-peak hours, late night. Used as a capacity filler, endless shrimp becomes a tool to turn empty dining rooms into modestly profitable volume instead of turning Friday dinner rush into a loss-making spectacle. Because of that simple scheduling discipline, labor is smoother, the kitchen breathes, and the promotion stops cannibalizing the very hours that keep the lights on. All of this only works, though, if the expectations are drawn like a contract. Clear rules, clear limits, no hidden gotchas. Endless refills on these 3 shrimp dishes, up to X plates of premium options, dine-in only, 1 guest per order. When the boundaries are honest, perceived value survives, and the few ruthless outliers who would stay 6 hours working through 20 plates stop being a financial extinction event. Which leads to the uncomfortable truth: these options existed. Tiering, bundling, timing, communication. Other chains use them every day. The decision to go permanent at $20 without serious guardrails starts to look less like ignorance and more like something darker, more desperate. And to see that desperation clearly, the story has to zoom out from the plate in front of one guest to the boardroom where an entire chain was being quietly squeezed. To the boardroom where an entire chain was being quietly squeezed. But while the squeeze happened on spreadsheets, the pain landed somewhere else. There was a time when closing underperforming locations sounded like a tidy line in a press release. In real life, it meant a Tuesday afternoon meeting where a general manager in Ohio told 40 people, some in their Red Lobster polos, that the restaurant would not reopen next week. No severance empire, no golden parachutes. Just schedules erased and paychecks that stopped. Let me take you back to one of those stores in a highway town of 15,000. The mall died years ago, the factory downsized, and Red Lobster was one of the last places where families still sat down for birthdays and anniversaries. Cooks who'd mastered the exact shade of golden brown on shrimp for 20 years, servers who knew regulars' orders and kids' names, dishwashers who took the late shift because of daycare, all suddenly found out that their entire world of work had been priced at zero. For many, this wasn't just a job, it was a life script. One manager in Florida had been there since the 1990s, through General Mills, through Darden, through every new logo on the training manual. His story is one of loyalty that outlasted 3 corporate owners, 4 point-of-sale systems, and more menu redesigns than he could count. Yet when the lease was rejected in bankruptcy court, the only notification was an email and a lock on the door. The empire had moved on. His mortgage had not. In small towns across the country, the closures didn't just erase wages. They hollowed out the social map. The church, the high school stadium, the Walmart, and the Red Lobster formed a loose triangle of community life. When one point vanished, birthday dinners shifted to drive-through bags eaten in parked cars. Local charities lost gift card donations. The high school lost the one employer willing to work around Friday night games. Because decisions were made in distant boardrooms, chasing money, protecting power, and moving line items on quarterly reports, the consequences showed up as missed rent, overdue car payments, and grandparents who no longer had a place to take the family when the Social Security check hit. It's an example of what happens when a promotion designed in a conference room collides with the razor-thin margins of workers already one broken transmission away from real poverty. At times inspiring, and at times chilling, the endless shrimp story is framed as a viral bargain, a meme, a punchline about people eating a company to death. Yet the people who paid the highest price weren't the ones stacking plates. They were the ones suddenly explaining to their kids why the uniform hanging by the door wouldn't be needed anymore. Behind every endless promise that breaks, there is a very finite list of names, faces, and families who finally run out of options. There was a time when beating the system meant sneaking an extra refill or using a coupon twice. Now it means turning a $20 endless shrimp promo into a viral sport, a public contest to see who can extract the most value before the whole thing collapses. It feels clever. It feels harmless. But it quietly reveals something about the way life, money, and pressure have changed. Because wages have stalled, while rent, groceries, and everything else climb, the appeal of a great deal is not mysterious. A family walking into Red Lobster with $40 and walking out completely full is not greed, it is survival math. When every bill feels like an ambush, all you can eat sounds less like a marketing slogan and more like a rare moment where the customer finally has the power. Social media takes that instinct and pours gasoline on it. Platforms reward the person who finds the hack, who shows how to sit at a table for 3 hours, cycle through plate after plate, and turn one promotion into a personal buffet empire. The comments cheer, the view count climbs, and the quiet question of whether this is sustainable for the restaurant never even appears on screen. It is an example of what happens when the algorithm cares only about spectacle, not whether the doors stay open next year. Yet most people also have favorite places they want to survive. A birthday spot, a booth where a breakup happened, a chain that for all its corporate flaws holds pieces of their own story. The tension is simple and ruthless. Do customers want to win every transaction, or do they want those places to be healthy enough to keep existing? A restaurant that never wins on any deal does not turn into a folk hero. It just quietly disappears from the strip mall. On the level of the individual, piling shrimp high for $20 is rational behavior. The sign promised endless. The server keeps bringing plates. The math works. But when too many people behave that way, night after night across hundreds of locations, the collective outcome flips. Margins vanish, hours get cut, maintenance gets delayed, and suddenly the fun promo is one more weight dragging a fragile business underwater. So here is the pattern interrupt. When people cheer that a company lost money on them, what exactly are they celebrating? If the victory is that the promotion was unsustainable, then the prize may be the slow erosion of the very experiences they claim to love. The next time an offer looks too generous to be real, it might be worth asking whether the goal is to beat the house today, or to make sure there is still a house at all tomorrow. Because this is not only a story about shrimp, it is a story about expectations, about how far a deal has to go before anyone asks what it costs to keep the lights on. And in the next part, the numbers behind Endless Shrimp will show just how thin that line really was. Because this is not only a story about shrimp, it is a story about an empire that rose from a single Florida dining room to 700 glowing red signs across America, then watched a $20 promise crack its foundations. There was a time when Red Lobster was the taste of affordable luxury, the place a family went when it wanted to feel rich for one night without needing Rockefeller money. Let me take you back to 1968 to a small seafood restaurant in Lakeland, Florida, where the original idea was simple: bring ocean food to people who live nowhere near the ocean. That little startup caught the eye of General Mills, then Darden, and with corporate money and corporate discipline, the chain spread through suburbs and highway exits, turning cheddar biscuits and lobster tanks into a middle-class ritual. For a while, his story is one of expansion at scale, predictable margins, and a casual dining empire that seemed too entrenched to fail. But empires rarely fall in one day. After the spin-off from Darden, the tone changed. Private equity arrived with spreadsheets, sale-leasebacks, and a ruthless focus on squeezing cash out of real estate. Thai Union arrived with shrimp, ownership, and every incentive to push volume. Costs were cut, menus were simplified, leases were locked in at high rents. The machine still looked powerful from the outside, but the gears inside were grinding. Into that pressure cooker walked Endless Shrimp. Once, it had been a controlled, limited-time traffic driver, turned on for a few weeks, then shut off before the food cost bill came due. In 2023, it was made permanent at $20, then nudged higher, and suddenly a promotional lever became a structural obligation. Models said the average guest would tap out after a few plates. Human behavior said otherwise. People skipped pricier entrees, camped at tables for hours, and treated the deal as a mission. The result was not just an $11 million operating loss in a single quarter. It was collateral damage radiating outward. Workers saw hours cut, then locations closed. Landlords lost anchor tenants and years of expected rent. Suppliers and franchisees were left holding contracts and inventory tied to a brand now in Chapter 11 with over $1 billion in liabilities. Whole communities lost one of the few places where birthdays, graduations, and Friday paychecks had been quietly celebrated. At times inspiring and at times chilling, the life of this chain is a business parable. It is an example of what happens when greed and ambition go unchecked, when overconfidence in models and underestimation of people turn a $20 promo into a $1 billion problem. The numbers behind Endless Shrimp are shocking, but the mindset behind them is even more revealing. Because the story does not end with Red Lobster. It continues every time a menu, an app, or a billboard whispers, endless, unlimited, or too good to be true. The real question is what those promises are hiding in the fine print, and in the next section, the incentives behind those words will look a lot more dangerous. So what do you actually do with a story about a $20 shrimp deal that helped sink a 700-restaurant empire? It's entertaining in a train wreck way, but if it stops there, the lesson is wasted, and the next endless offer will be waiting at your door. There was a time when all you can eat sounded like harmless fun. Now, every time a menu screams endless, unlimited, or lifetime, the smarter question is quiet and simple. How does this business make money on this offer? If the only honest answer is they don't, then someone is gambling with either your money, your data, or your future expectations. That small habit, that one question, is a shield against a lot of very expensive illusions. Because Red Lobster is not just a restaurant story, it's a mental model. When you look at an investment that promises high yield with no risk, a job that pays huge bonuses with no clear path to profit, or a partnership where one side gets volume and the other side gets volatility, this story should echo in the background. His story is one of misaligned incentives, at times inspiring and at times chilling, because everyone thought they'd found a clever angle and the math quietly disagreed. For anyone running a business or a side hustle, this is where the warning gets personal. Endless, shrimp-packed dining rooms generated headlines and trained customers to believe that $20 bought near infinite seafood. That traffic spike felt like success, but it was success that bled cash, warped the brand, and made normal prices look like a ripoff. When an offer teaches your customers that your real value is unsustainably cheap, you are not building wealth, you are rehearsing collapse. So the filter becomes simple. Favor brands that are honest about limits, that say bottomless until 4 p.m., or great rate for the first year, and actually explain the trade-offs. That kind of transparency may feel less magical, but it is far more compatible with a long life for both you and the company. The louder a business shouts endless with no clear plan, the more it deserves a raised eyebrow and a closed wallet. Let me take you back to the feeling of watching those crowded dining rooms and thinking, this must be working. It's an example of what happens when the surface looks powerful and the foundation is quietly cracking. If dissecting how a $20 plate of shrimp helped erase hundreds of millions in value was useful, there are many more stories like this, where the marketing gloss hides the real machinery of money and power. And in the next section, that machinery is going to look even more ruthless, because Red Lobster is not the only place where endless has a hidden bill. Red Lobster is one chain, one story, one empire that went from national comfort brand to courtroom exhibit. But the reason this collapse feels so unsettling is that it taps into a deeper curiosity. How can a single decision, a harmless-looking $20 plate, quietly load $1 billion of risk onto a company that millions assumed was safe? There was a time when endless shrimp sounded like a fun promotion. Now it sounds like a warning label. If this breakdown made the menu feel less like dinner and more like a balance sheet, that reaction is the point. His story is one of Rockefeller and oil, Red Lobster and shrimp, tech founders and free shipping, all sharing the same skeleton, tiny levers that move enormous amounts of money and power. Watching a 700-restaurant chain misread human behavior, misprice its own generosity, and finally stumble into Chapter 11 is not just trivia, it is an example of what happens when marketing fantasy outruns economic gravity. So if the hidden mechanics behind this deal were useful, stay for more stories where the illusion is peeled back. Promotions that look generous but are engineered to trap attention. Loyalty programs that feel like gifts but quietly harvest data. Limited time offers that never end, because the real product is not what is on the plate, it is what happens to the customer over a lifetime. The goal is not to dazzle with slogans, but to walk through the back door and see the ledgers, the leases, the debt covenants, the quiet panic. Subscribing here is not framed as a favor to a creator. It is a way of voting for content that treats viewers like insiders, not targets. A like tells the algorithm that slow, methodical autopsies of business myths should not be buried under 30-second hype reels. A share says that friends should know why too good to be true offers keep appearing, and how to read the fine print behind the smiling mascot. If this shrimp story hooked you, let me take you back to other moments where endless nearly ended companies. The all-you-can-fly airline pass that turned into a financial black hole. The free delivery e-commerce boom that built empires on negative margins. At times inspiring and at times chilling, these cases show how empires are built by the same logic that sometimes destroys them. Because somewhere right now, in another industry, the next endless shrimp is already live. Different product, different slogan, same quiet math. Understanding this story is how the warning light turns on early, long before the bankruptcy headlines arrive. So let me take you back to that opening scene. A packed dining room, families squeezed into booths, servers weaving through a maze of plates, and every table anchored by the same promise printed in bold type, endless shrimp, $20. It looked like victory. It sounded like a comeback. Not only were the dining rooms full, they were fuller than they had been in years. There was a time when that image was the dream of every casual dining CEO. Full parking lots, kitchen printers screaming orders, managers high-fiving because the promotion worked. Now let that image dissolve. Same building, same sign out front, but the lot is half empty. The lights are off for good in 100 locations, and the only endless thing left is the paper trail in bankruptcy court. The noise of crowded Friday nights has been replaced by auctioneers selling off used fryers and booths by the pound. Because nothing in business is truly endless. Not shrimp harvested from finite farms and oceans. Not growth, no matter how many promos promise traffic forever. Not investor patience, even when a global seafood supplier is on the cap table. Only the consequences keep going. The leases that have to be paid, the employees who have to find a new job, the suppliers who quietly absorb another unpaid invoice. Endless shrimp worked until it didn't. It drove traffic, then it drove losses, then it helped drive a 700-restaurant empire into Chapter 11. It's an example of what happens when a marketing fantasy outruns the fragile math of reality. The story is not just about shrimp. It is about believing that volume can replace margin, that you can make it up on quantity, that human appetite will politely stop right where the spreadsheet needs it to. So what should you take with you the next time a deal sounds too good, too abundant, too permanent? A little skepticism, not cynicism, just respect. Respect for the quiet equations under every endless offer, for the cost of labor and rent and ingredients that never make it into the commercial, for the people whose paychecks depend on those equations working. Real experiences are held up by thin columns of math. Kick out enough of them, and the ceiling comes down. His story is one of money and power. Red Lobster's is one of menus and margins. Both are at times inspiring and at times chilling, because they show that the universe does not care about slogans. In the end, it was never the shrimp that sank a 700-restaurant chain. It was the belief that you can defy gravity for $20 a plate. If this story sharpened your sense for that gravity, do not let it end here. Carry that warning light with you, and if you want more stories that peel back the fantasy to show the math underneath, you know what to do next.